You may recognize some of the names. Coca-Cola is there, Johnson & Johnson is there, General Electric is on that list. So this is a list of companies that have increased their dividend every single year for the last 25 years. They did not miss 1 year. If they did, they would not be on this list. What's even more surprising are some of these other companies I've highlighted. Johnson & Johnson has been increasing the dividend for more than 46 years consecutively, because I know they increased it again this year, so we're at 47 years. Coca-Cola, same thing, 46 years. Again, this year it went up, so we're at 47 consecutive years. Emerson Electric, 51 years. And here's another list. We've got lots more companies here, and the one I've highlighted is Procter & Gamble, which has had 54 years of consecutive dividend increases. So yes, the dividend is not guaranteed. Companies can eliminate it any time. Nobody knows what's going to happen in the future. I can't predict the future with any of these companies on the list. However, when I look at this list, I can have a very high degree of confidence that, for example, Procter & Gamble will continue to pay a dividend next year and increase it, because they have done so for the last 54 years. Worst case scenario, they would probably keep it the same. But the likelihood of them eliminating the dividend or decreasing it is very, 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 very low. Here are some Canadian companies. Here are companies that have been paying dividends for 100 years or more. So that's going to be on the left-hand side of the screen there. It's important to note that Toronto-Dominion Bank, TD Bank, has not missed a dividend since 1857. And the other one, the Canadian Imperial Bank of Commerce, CIBC, has not missed a dividend since 1868. So that is very impressive. On the right hand side of the screen are a list of companies that have been paying dividends for more than 50 years. And again, you may recognize some of these names. Canadian Tire is on that list. Maple Leaf Foods, TELUS is on that list. Here's a list of companies that have been paying dividends for 25 years or more. So when you look at this list of companies, this should give you some reassurance that dividends, especially from these companies, will continue to be paid out. And you don't have to be worried about these companies eliminating their dividend or reducing their dividend. It may happen, but then again, when we build a portfolio of stocks, we're not just buying one single stock in there. We do have other stocks in there who will continue to hopefully increase dividends year after year. So let's revisit the rule that we left off with. Has the company had consistent dividend growth? If the answer is no, then that is a company we're not interested in buying, and you should not be investing your money in that company. Let's take a look at Company A. So here's a little graph. Those little dots represent dividends, and you can see over time, as you read the graph from left to right, you can see the dividends gone down. So the amount of dividends the company pays out has gone down year after year after year after year. This is not a company that we are interested in investing in, because this is showing me that next year they're going to decrease the dividend again or eliminate it altogether. Company B, you can see the dots are all over the place. The dividend goes up, then it goes down, then the dividend is eliminated altogether, then it comes back up again. Company B is completely random. We have no confidence as to whether the dividends are going to go up or the dividends are going to go down. So this is another company we're not interested in. Company C is what we like to see. We like to see a steady increase of dividends year after year after year after year, because we are essentially we're trying to build a stream of passive income, and you want the income to keep coming in after year, and you want the income to keep growing year after year. So Company C is something that we would be interested in investing in. Okay, here's the next rule. Is the company undervalued? Okay, you've all heard the phrase buy low, sell high. You want to buy when the company is low. Okay, remember our statement in the beginning? Buy quality stocks when they're undervalued. So if we look at our stock price graph again, you want to buy the stock at $14 or maybe $15 or $13. And that's where you're going to maximize your profit, because then you can turn around and sell it when it gets to $51 or $50. You don't want to buy it at $51 or $50 because you're not going to make any money off of it. So to help us understand when a stock is undervalued or when it's priced low, we're going to cover this concept called high dividend yield. So this is very, very important. This is the entire Simply Investing course is based on this concept and on this rule, is the high dividend yield. So I do want you to focus on this. So if you are watching TV on the side, or you're sending an email, or you're on Facebook, you do really need to sit down for this slide, to sit down and focus on the next couple of minutes here of high dividend yield, because this is going to let you know when a stock is undervalued, when you should be buying the stock. Now remember, we looked at the dividend yield, which is the dividend divided by the share price. So the dividend is 10%. Now let's say in this example, our company XYZ, let's say somebody, some financial expert goes on TV on CNN and says, oh, I think a recession is coming, or a double dip recession is coming, or the credit crisis, or whatever negative news. I sound a little sarcastic, but I mean, the media likes to sell bad news. Bad news sells. It sells ratings, it sells newspapers, increases ratings, and sells advertising space. So in any case, and we see this happen all the time. Somebody gets on the media, on television, on the internet, and says, it's over, the economy is over. So in this case, what happens to company XYZ is their share price, a week from now, drops to $5. What happens to the dividend yield? You see, the yield has gone up. It's now 20%. So was it better to buy company XYZ today, when it's at $10 a share? Or would it be better to buy it next week when it's $5 a share? Right? It's better to buy the company when it's $5 a share, because you're going to be able to buy more shares. So a $1,000 investment today would give you $100 in dividends every year. A $1,000 investment next week in the same company would give you $200 in dividends every year. Okay, so this is what I call the law of dividend yield. This is very important. When the share price drops, the dividend yield goes up. And that's the example that we just talked about. Okay, this is important, so I'm going to repeat it again. When the share price drops, the dividend yield goes up. And the opposite is true, so when the share price goes up, the yield is going to go down. So you want to buy a stock when the yield is up. Correct? Because you're going to make more money. Do you want to make 10% return, or do you want to make 20% return in this example? Right? You want to make 20% return. So if you want to make 20% return, you're going to have to buy the shares when they're low. Remember, buy low and then sell high. Buy when they're undervalued. So when the share price drops, the yield goes up. So here's an example of, again, company XYZ. Stock prices go up and down all the time. If you were to know the average dividend yield for this example, let's say I told you the average dividend yield was 4.5%. Okay, you can get this information from a number of online resources, or you can calculate the value yourself. So in this example, the average dividend yield is 4.5% for this stock. When the current dividend yield is higher than the average yield, the stock may be undervalued. So let's take a look. So if we look at this stock today, you look up the share price on Yahoo Finance or MSNmoney.com. There's a whole bunch of websites that you can just put in the stock symbol, and it'll tell you what the stock price is, and it will tell you what the dividend yield is today. So if today the current dividend yield is 9% and the average is 4.5%, 9% is higher than 4.5%. So then we make the determination that the stock is undervalued. The stock is priced low. When the current yield is, let's say, 2%, then the stock is priced high. You don't want to buy it when the yield is at 2%. You want to buy it when the yield is at 9%. So I'm not sure if you can see this on your screen, but it's sort of the blue area that we've highlighted below the dotted line. So the area below the dotted line is your buying area. That's when the stock is going to be, historically, it's going to be undervalued. So if you know what the average yield is, then you can know whether or not to buy a stock, or to skip, or to wait till the stock price drops, and then the yield is going to go up again. So the statement at the bottom, I'm going to repeat it again because it is important. When the current dividend yield is higher than the average dividend yield, the stock may be undervalued. Okay, so this rule is very important. You want to buy stocks when they're undervalued. This is the one rule that I don't negotiate on. if you're looking at any stock, any company, McDonald's, Starbucks, Canadian Tire, Petro-Canada, any stock, take a look at its current yield. If it is higher than the average yield, then continue further and look at the rest of the rules. And this is a stock that you may want to consider buying. But if the current yield is less than the average, move on. Move on to the next stock. This is a stock that is not the right time to purchase it. Okay, so that's very important. So now we've covered all of the 4 rules that we wanted to cover. The next section up is mutual funds. Because people will come back and say, you know, all this is nice and fine, but I still feel comfortable buying mutual funds. You know, I want to leave it to the experts. So before we start, actually, let's have everybody on the same page. What are mutual funds? Basically, they pool money from lots of different people, and they invest that money into stocks. So that's what a mutual fund is. So when you go out and buy mutual funds, and I go, or anybody goes out and buy them, I wouldn't buy them, but if other people did, all that money would be pooled together into one account, and the fund manager is responsible for buying and selling stocks. And that's all they're doing. So people do say, you know, well, I'm going to leave it up to the fund manager. They're the experts, they're the professionals, they're going to do a good job at investing my money. That isn't necessarily true. So let's take a look at the 5 reasons why mutual funds fail. Okay, there's a whole bunch of them on the list here. We're going to go through them one by one, so you don't need to sort of worry about all that text on the screen. So the first one is fees, especially high fees. Most people are not even aware of this. Mutual funds, it's sort of like a hidden fee, have what they call an MER, a management expense ratio. The average MER in Canada is 2.2%. Unfortunately, in Canada, we pay some of the highest MERs anywhere in the world. So I'll give you an example. So if you get a statement at the end of the year saying that, you know, here's the mutual funds that you own, the performance last year was 5%. In reality, the fund actually did 7.2%. Okay, so they've deducted 2.2%, which is their management expense ratio. So they will deduct that right off the top, and then the statement will say your fund performed at 5% this year. Let's say you get a statement and it says your fund did minus 3.2. Okay, in reality, the fund only dropped by 1%. The mutual fund company again took their 2.2%. So the mutual fund company will always make money, whether or not you make money or you don't make money, because they will always take out their 2.2% fee right off the top. Now, this doesn't sound like a lot. People say, well, it's only 2%, or some mutual funds have a MER of 1.75, and it doesn't sound like a very big number. But let's take a look at this. $1,000 invested in the stock market 50 years ago today would be worth over $500,000. With a fee of 2.2%, you would only be left with $193,000. Okay, this is huge. $321,000 would have been lost to fees. And that is a staggering amount of money to pay just for fees. Here's another example. It's a little closer. People think 50 years, you know, they say, well, that's a very long time. So let's take a look at this. $10,000 with a rate of return, let's say, of 10% annually, in 25 years would be worth $108,000, right? If you had a management fee of 0. And when you tack on the fees, you can see that your mutual funds are worth less and less and less. Let's take an example here of a typical fund where the MER is 1.5%. Now that's being generous, because the average MER in Canada is 2.2. But let's take 1.5% here. Over 25 years, $34,100 would be lost to fees. With the same $10,000 invested in 4 stocks, and that all depends, you know, that could be 2 stocks, or, you know, we took 4 as an example. Over 25 years, the amount lost to fees would be $79.92. Okay, now that's not a typo. That is $79 versus $34,000.